Hey, American Airlines pilots, you've got until December 15th to make a key decision regarding your participation in the market-based cash balance plan. If you make over $260,000 in a year, this choice will affect the next 3 years of your take-home pay versus your tax implications. I'm Mark Covell with Leading Edge Financial Planning, a fee-only fiduciary helping our pilot families navigate their financial future. Thanks for joining me today on our cash balance plan discussion. In this video, we're going to talk about what a cash balance plan is, maybe some of the unique differences that exist at American Airlines, as well as some scenarios of what it might look like when it gets implemented. So a cash balance plan is simply an extension of a qualified retirement plan, and the big lifting muscle is going to be our 401k. We get an 18% non-elective contribution starting in 2026. Now, there's some IRS limits to how much money can go into our 401k. So what a cash balance plan does is it lets us get past those defined contribution limits and get additional tax-deferred savings in an account called a cash balance plan. So what does it look like is the defined contribution plan will stop money going into our 401k once we've got a total of $72,000 starting in 2026 between what we defer and what the company puts into our 401k, or we've reached $360,000 in total compensation. Once either one of these triggers is hit, the IRS is going to stop that 18% from going into our 401k. Currently, for folks that are hitting any of those limits, those dollars are showing up as spillover cash, which comes at the end of the year as income that gets taxed at our marginal tax rate. And for many pilots, it can feel kind of like a holiday bonus because it usually happens towards the end of the year. However, we do pay some taxes on it. For 2026, we'll have the ability to make an election where we could take that money, put it into a separate account, and we can defer the taxes on that. So the key things that I want you to know is starting on November 24th to December 15th, there's going to be a special election outside of the annual open enrollment where we can make an election. Do we want to be tier one, which is spilling over to our market-based cash balance plan, basically the new option. Tier two is basically going to keep everything status quo. We would take excess contributions as income. Another key aspect of this cash balance plan is this is not a one-time career election like it has been at other airlines. Every 3 years, we will have the opportunity to change between tier one and tier two. I think this is a key aspect of how the American Airlines plan differentiates from some other companies' plans. Some of the highlights for young pilots, especially that may not know their future tax situation, their future cash flow needs, this is huge. They can make an election now, and then as life changes, they can alter it. So again, that 3-year window is going to happen in perpetuity. Every 3 years, we can change between tier one and tier two. Okay, that is unlike any other plan that I'm aware of, and a huge kudos to the APA union for negotiating that. The next key benefit is there's no cap in how much spill cash can come in. We'll get to a couple examples of what exactly that is, but that 18% non-elective contribution, once we hit the IRS limits, has to go somewhere. For some market-based cash balance plans, there's a limit that we can only put so many dollars in the cash balance plan. And outside the scope of this video, there are some limits that are set by actuarial rules, and we won't get into, but essentially, no pilots at American Airlines will ever reach the amount of money that could go into the cash balance plan that would trigger any limits. So essentially, there is no limit for us. Next, investments. Now, the way that cash balance plans work is they're a defined benefit. So there's some rules associated with them. They are generally more conservative in nature than maybe what you would invest in on your 401k. Any dollars that go into it can have a credit amount associated with it. And that is really intended so that you're never in the red. So if you were to put couple $100,000 over the course of your career into it, you would never lose money on it. Any money that it makes would be considered an interest. All these funds do get pooled together, so you don't have individual investment discretion. Many of them have pretty rigid rules on how they invest, maybe a 40% equity allocation and a 60% bond allocation is pretty standard. Fidelity is our custodian. Initially, they will start fairly conservative. However, over time, based on performance, there is some freedom for them to take on more equity investment exposure, which would allow for hopefully higher expected returns. So again, we view that as a positive, that there might be slightly more aggressive investments over time through this and still have the pretty much no guarantee of losing money on these on this investment option. Lastly, all cash balance plans have the option to either take money from this account as a lump sum. You can do that as early as 59.5 based on ERISA rules. You could roll it over into an IRA if you choose, or you could leave it in the cash balance plan. Upon retirement, you could take it as an annuity, or you could always do a rollover later on as well. So there are some nice options of a lump sum versus annuitizing. Let's jump into a couple examples of how does this look like. First off, this pilot, I'll walk you through, is making $260,000 a year. In their 401k, they're deferring 15% of their paycheck. That could either go into Roth or pre-tax or a combination of the two. So 15% of the paycheck is going in. The company's putting in 18%. So over the course of the year, their monthly savings in blue shows what the company is contributing. What the pilot is deferring is in orange. And as you can see, by mid-August, they've already reached their maximum deferral limit of $24,500 under the age of 50. Additionally, this pilot is hitting their $72,000 maximum 401k contribution at the end of December. So there is no ability to have any spill cash left over to go into the market-based cash balance plan or to take that as additional taxable income. This next example, all we've changed is the earnings. They're making $320,000 a year, still deferring 15%. In this situation, this pilot's reached their max contribution, max deferral in July, and they've hit their $72,000 limit in October. So by November and December, that 18% from the company can't go into their 401k. So it's going to be designated as spill cash. That $10,000 currently would be coming to this pilot as taxable income, and they'd see their paychecks increasing for the last couple months. If this pilot was in, let's say, the 32% marginal tax bracket, that $10,000 would be taxed, and they'd really be taking home $7,000 of that, roughly. If they were to select Tier 1 option to have that money go into the cash balance plan, then all 10,000 would show up there and they would have no tax implications for the year that they earned it. Next example, only difference is they're still making $320,000. This pilot is only deferring 5% instead of 15% of their money into the 401k. They're not going to reach their maximum $72,000 until the month of December. Here they've got $1,700 left of spill cash. That would either be taxable income if they were Tier 2, or it would go into the market-based cash balance plan if they were Tier 1. Just showing you that there's a range between $260,000 and $360,000 where the amount that we defer is going to affect how much spill cash is left. In our last example, this is a higher earner. They're making $480,000 a year. They're deferring 15%, and again, 18% non-elective contribution. This pilot, by May, they've already reached their max deferral, and by mid-July, they've already reached the $72,000 maximum that can go in their 401k. The remaining 18% NEC for the rest of the year is going to total almost $40,000 for this pilot. That's a significant amount of money that currently would be getting taxed at a marginal tax bracket. If this pilot were to have an employed spouse, maybe they live in a high tax state, they could be tax it close to 50%. So they could only be taking home closer to $20,000 of this close to $40,000 that they've earned. With the market-based cash balance plan, again, all $39,000 could go into that account, be invested accordingly, and they could defer the taxes on that. It's a great way for high earners to continue a high level of savings into retirement. Okay, so in review, the special election window opens November 24th. It closes December 15th. This is outside the annual benefits election window. The next opportunity to change between Tier 1 and Tier 2 will be in 3 years from now for the calendar year 2029. We recommend you reach out to an advisor, whoever you trust. You can contact me, Mark, at Leading Edge Planning. My number is 530-539-1466. Again, this video is for educational purposes. This is not financial advice. Do appreciate you joining us today.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.